Will a slowing global economy crash stocks? Is there more evidence that the peak in yield is in? And are we potentially going to see negative interest rates? And what does that mean? I'll answer those questions and more on today's Macro Show. I'm your host, Steven Van Metre, and thanks for joining me today, because the question on your mind should be, what does a slowing global economy mean to stocks and yield? And why should you be paying attention? Because we're going to take a look at the Global Purchasing Managers Indices, PMIs. And what these are is they're a survey of manufacturers from countries all around the world. And when you start to see a peak in them, it usually means the stock prices are going to peak in about 3 months later. It can go as long as 6, can be shorter, but you're now in what we'll say is a 6-month window. When we look at the prices paid, when we dig into the US data in particular, the prices paid data where it peaks, I generally also suggests a peak in Treasury yields, which is kind of odd because we've been looking at that before. So let's start out and take a look at this, because if we're seeing peaks, and that means you should be on notice that there's a market peak looming here in the near future. So let's start out with the economic data and see what it says, because let's go to Australia. Now, the way you read these are what are referred to as a diffusion indices, and if they are at 50, it means unchanged. If they're over 50, the higher they're over 50, the greater the rate of expansion. If they're under 50, it means contraction. So what are we looking at? Let's just go right to Australia. Manufacturing PMI last month, 58.6. This month, 56.9, expanding at a slower rate. Still expanding, but remember, we're looking for peaks. How about we head over to South Korea, the Nikkei manufacturing PMI. It's expanding at a slightly slower rate from 53.9 to 53.0. How about Japan? Now, this is the one that actually went up, 52.2 to 53. Now, before you celebrate, just keep in mind, Japan is in pretty bad shape. So while this is an improvement over last month, broadly speaking, it's not a big deal. How about we head over to China, and now we look at their manufacturing PMI, 51.3 last month, 50.3 for July. Virtually saying that is stall speed. And why does China matter? It matters more than almost any of these except the US. Well, here's why. This chart from PPG Macro, big thank you to them. We have China and US manufacturing PMI saying that where China goes in the red, the US follows. And why would China lead the US here? It's simple. You have the world's largest exporter, the world's largest importer. So as China goes, so too does the US, suggesting peaks are in. Let's move into today's data, and we see German retail sales way up in June at 4.2%. And let's move on to, how about we head over to Spain, manufacturing PMI, expand at a slower rate, 60.4 to 59.0. Let's move over to Italy, 62.2 down to 60.3. How about France, 59 to 58. Germany, an outlier, 65.1 to 65.9. Europe, broad Eurozone, 63.4, 62.8. Again, all you're seeing is expanding at a slower rate. How about Great Britain, 63.9 to 60.4? You're seeing peaks are in. How about we head down to the U.S., where we have two pieces of data. We have the market, MARKIT, manufacturing PMI, expanding at a slightly faster rate, 62.1 to 63.4. And then we have the ISM. This is considered the quote-unquote official. It's not official because it's a government statistics. It's official because this is the one the market cares about the most. Manufacturing PMI, here you can see 60.6 down to 59.7. We're going to take a zoom in on this and look a little deeper. But again, what you're seeing is expanding at a slow rate, suggesting that potentially the market peak is either imminent or past. It's very close, and given where stock prices are, should suggest that it could be peaking at any point. There could be one final move up. How about construction spending for June? Up 0.1%, missed expectations of a 0.4% gain. Let's take a look at the ISM, because again, what are we focused on here? Is the peak in the ISM in? If so, then that means the peak in equity prices is coming soon. All right, let's look at the details here. Manufacturing PMI, we already looked at the number, and let's scroll down, and what do we have? When was the peak? March. So we have April, May, June. There's your 3-month window. We're now at month 4, so we're in that 6-month range, telling you that there might be one final move higher in equities, but the peak is telling you, because the factory sector is telling you that it is peaked, that the clock is ticking on equity prices. How about new orders? You want to know why perhaps bond prices went up a bit today? We'll see here the peak in new orders was back in May. So now all of a sudden the number of firms reporting new orders is slowing. Not much, but enough. It's slowing a little bit. And if you're looking for inflation and a surge of global growth, you want to see new orders continue to rise. How about production? Well, it peaked back in April. So more evidence of a peak. How about employment? Well, employment's been going nowhere. At 52.9, at least it says the manufacturing sector hired a little bit over the prior month, the peak being in April. Again, more evidence, peaks. How about supplier deliveries? Peaked back in May. Inventories, which is odd that companies are complaining about inventory levels, because we keep seeing at the wholesale and retail level, inventories are rising, yet the survey data says they're still not rising fast enough. We see, look at July's data, 48.9, slight contraction in inventories, with a peak being in June. That is at the manufacturer level. How about customer inventories? They keep saying that they're too low. Strange. How about prices? Now, this is the one that tells you if where Treasury is peak, because where prices paid peaks, then you're at anywhere from 0 to around 3 months of peak in consumer prices. And here you have, when was the peak? In June. Remember, Treasury was peaked in March. So the bond market already figured this out. It already knew. So how about the backlog of orders? You want to know where inflation comes from? When orders stack up. When did it peak? Back in May. So what did the market look at all this ISM data today and tell you? That the peak is probably in for equities, or is really darn close. And as far as the bond market goes, well, there's some more information that probably is going to help the bond market, and that means the crowd's about to come out. Let's take a look at what the Treasury announced today. And we're going to go over to zero hedge. We're not going to go this whole article because I'm not overly interested in it. The stealth QE is over. Treasury projects adding $300 billion in cash by December 31st, reversing the liquidity tsunami. Now, let me explain to you what the article is going to say, and then we're going to go right to the end of the part that really matters to most. Is, as far as the market's concerned, is when the Treasury is draining down its cash flow. So think of it like you're spending down the money in your bank account, that it is easy injecting money into the economy. So now the Treasury is saying we're going to raise our cash balance. And there's some good news to that, because there is a massive collateral shortage out there that we've talked about, and this will help ease that problem a little bit. But the market, in terms of interprets this as, wait a minute, you're going to pull cash out and park it in your savings account? They don't like that. But let's go to the end of this article, because there's something super bond bullish here, and I want to show you that. If we go all the way down to the end, you see here it says a much more detailed picture of the Treasury's funding needs will be unveiled on Wednesday. So we'll talk about that when the Treasury releases additional details about its borrowing plans. As Bloomberg notes, for the first time in more than 5 years, the Treasury in coming months will be scaling back its mammoth quarterly sales of notes and bonds. Oh, yes. According to Wall Street Journal dealers, a shift so large is likely to more than counter the Federal Reserve's potential pullback in purchases. Now, mind you, what you're seeing here is repeated views of why the Fed's going to taper. So all you're seeing is the Treasury now saying, oh, well, the Fed's going to taper its purchase, so we're going to taper our issuance. Well, maybe not. Now, that's the thing that we need to think about. And while most dealers expect no change in the $126 billion size of the recent refundings, many see officials setting the stage for a reduction in November. Okay, so now we have an estimated date. The surprising decline in net issuance that many speculate could be behind the striking drop in yields in recent months. Yes, because somehow everyone knew that. I doubt it. As there is nearly not enough supply to meet demand. That too will change, however, once the Fed begins tapering, and certainly once QE is over, although we aren't holding our breath. All right, so now you know why we're at the racetrack today. There's a castle in the background. There it is. We're on a different side of the castle. Crown's now back on, because what this means, if the Treasury is going to issue fewer notes and bonds, and the Fed doesn't change its purchases, that means the Fed is going to be over purchasing even more of notes or bonds, and that's going to drive yields lower. Phenomenal. Now, what could this mean for rates? Could they go negative? Well, they could. Let's take a look at what that might look like. And we've got a chart from big friend of the show, Brent Johnson of Santiago Capital. He sends out today on Twitter a regression channel, and here he shows 10-year Treasury yields rolling over. And what this means is yields are following this pattern down. And in prior times of tightening, yields have had to get down to a point low enough to spur lending growth. And based on this regression channel, that means here's zero right here, that the next major destination for 10-year Treasury yields is negative. And that would be huge, because we've got the crown on. Bond King, what do we want? Negative yields. Yields go down, bond prices go up. Many of you ask, could that mean for the long bond, the 30-year? Well, you could possibly see rates down to zero, maybe even negative, depending on how deep yields have to go to spur lending growth. And on the topic of lending growth, we can see there's none of it. So all this notion of taper and everything doesn't make any sense, because here's the data from Friday that says real estate loan growth, slightly negative. The 6-month and 3-month rate change are effectively at zero. So there's no growth at current yields. So this idea that the Fed's going to taper doesn't make sense there. How about commercial industrial loans? Well, it's negative on a year-over-year basis, but the 3 and 6-month rate change are still negative. So that doesn't make any sense from a taper perspective. How about total loans and leases, all bank credit? Growth rate is up to a negative 2.11 from a year ago, again suggesting that rates are too high, and the 6-month rate of change and 3-month rate of change are marginally over zero. So there's nothing there. In fact, even the consumer credit card growth rate is a whopping 0.69% year over year. So it's telling you very clearly there is an insufficient amount of demand at current yields, which would then imply the Fed's not going to taper, especially since they've got this massive unemployment problem. But what could negative yields mean for stocks and Treasury yields? Well, let's take a look. And consumer prices. How about the CPI? Everyone thinks consumer prices now only go up. Well, historically it says when interest rates go down, when the blue goes down, it's telling you you don't get lower yields and higher consumer prices. It's telling you see it right here in the great financial crisis, a perfect example. Here's another point. Yields go down, consumer price inflation heading lower. What does that mean for stock prices? Well, when you have a period where stock prices are high and yields are falling, and yields are not falling in creating lending growth. So this is an important aspect I want you to understand, is falling yields tighten financial conditions and only can ease them when new money is created through lending. So when you're late cycle, what you are now, and you see yields falling, it's telling you that rates are too high and there's not enough money in the system. It's trying to create that. And if rates don't fall enough to spur lending growth, rates continue to fall until they do, and that tightens financial conditions and leads to a crash in asset prices. Here you can see it with the Wilshire 5000, yields going down, stock prices to fall, yields going down, stock prices to fall, yields rolling over. Tells you at some point stock prices to fall. Let's talk about the money supply, because a lot of people are making a big deal out of how the money supply is inflationary, and yet it's falling to a 12%, which is still huge, year-over-year rate of change. Expect that to continue to fall. Meanwhile, the Fed and their monetary base, their asset purchases continue to rise. You see the Fed's balance sheet now over $6 trillion. But what does all that mean? Well, is the money supply growth fast enough to sustain the economy? And the Money Multiplier says no. You take the M2, the money stock, divided by the monetary base, multiplied by 1,000, and what it's telling you is all of that money in the money supply over here is getting locked up in the financial system, largely between only a couple of banks. And we'll talk about how the velocity of money, and we nailed that call. We'll talk about that in an upcoming show for sure. And what does that mean for inflation? Well, when the money multiplier is headed lower, it says all that money in the financial system isn't moving. It's not going anywhere. You can't get inflation when that happens. So here you see the money multiplier rising, consumer price inflation rising, money multiplier crashes, inflation comes down, then the money multiplier, you come out of the recession from a negative number and you see consumer prices rise, but the money multiplier is trending down, consumer prices come down, finally the money multiplier heads up, suggesting that there is money getting out in the economy, inflation rises, and all of a sudden the money multiplier is rolling over. Consumer prices come down, and what it's telling you is there's going to be a hard rejection in consumer prices coming up. Now, we've got to take a look at how speculators are positioned, because if we now know that inflation is going to roll over, treasury yields are going to fall, and the Treasury is going to reduce issuance, and if the Fed doesn't cut its purchases, which we'll hope they don't, particularly the longer you're on the curve, the more you want the Fed to continue buying, is how are speculators positioned? Because if speculators are very short, that means they're going to get squeezed, and when they get squeezed, that drives bond prices up even higher and can accelerate into a financial tightening or recession type situation. So let's take a look. And that's why this is so important. So we see 10-year note futures are long. I'm going to bet this has to do something with computer algorithms such as CTAs going long, but market still remains fairly net short the 30-year, and we know that yields don't bottom until speculators are way long. So there's still a lot of short squeezing just in the futures market. Doesn't mean we're not even talking about those who are short the ETFs or short with options or any other way. We're just looking at futures. Let's take a look at other positioning. We see crude futures, they're still very long, but slowly backing off, suggesting that perhaps crude prices may be stalling out here. Looking at the S&P 500, market is still net long. Speculators are still not long. Euro, you see euro going down. This should suggest gold is going down due to the relationship between the dollar, euro, and gold. And look at gold. The speculators have been boosting their positions and not getting a ton out of it, suggesting that perhaps there could be a near-term peak in gold. Let's look at the NASDAQ. They're net short on tech. They are still heavily short on small caps. Can't get them to break down, but they're still heavily net short, and they're increasing their dollar longs. Now, you want to accelerate a tightening in financial conditions? Well, let me give you the recipe. You drive yields down and you drive the dollar up. So that way, that when people who are short dollars need dollars, they got to pay more for them. It means they have to sell other assets to get them. It's not what you really want to see unless you're looking for a risk-off move here. Let's go down to volatility. You'll see virtually unchanged. Still remain net short. Let's turn to our friend Stefan from Skyway Asset Management. Sends us these charts. And what he shows here is the commitment of traders. You're seeing the speculative positions, the commercials, and let's see, did he have the title up there? Nope. So this is the commercials are still net short, and this should be the non-commercials net short. He tells me massive short squeeze coming in his email. And let's take a look at this chart, which I didn't actually get a chance to look at. So we'll look at it together. And here we see T-bills and notes, and we see the positioning here still overall net short, and on at least on the red one, which can't be notes, so I don't know which one the red line is. He doesn't have a guide up here. But looking at T-bond futures, you see still negative here, and this must be TLT. So he's saying, look, big squeeze coming, drive TLT higher, and there you go. You've got the whole story about how this global slowdown is coming at the wrong time. And if the Treasury does, which we'll find out on Wednesday, go ahead and cut issuance later this year, and the Fed doesn't change, doesn't taper, and I don't think they can. I don't think with the unemployment rate being this high, I don't think with financial conditions tightening, with yields falling, that's a warning sign for the Fed. I don't think they can get away with tightening. That means higher bond prices, higher dollar, and boy, going to make the crown look even better. Thanks for being fans. Thanks for watching. We'll be back on Wednesday for the macro show. Maybe we'll get a preview of what's coming in the payrolls. Word on the street is could disappoint. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational information. It's not intended to provide investor and other advice. This video is not to be construed as a recommendation or solicitation to buy or sell a security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.